This is a very, very important topic for everyone here, specifically the CFOs. Like Manik said, that a lot of companies are already doing data analytics. But how do you protect yourself? How do you protect your companies? And this could be from the risk of fraud, this could be from the risk of non-compliance, this could be leakages and so on. So just to make sure that everyone understands, the topic for today, we are talking about forensic data analytics. Primarily, what does it mean, right? A lot of clients, they come to me and ask, what does forensic data analytics means? So I'm sure most of you know about it. But forensic data analytics primarily focused to detect any abnormal patterns. It could be in terms of, like I said, leakages. It could be fraud, non-compliance, bribery. That is called primarily forensic data analytics. So in today's discussion, I would be talking through in terms of how companies are more and more adopting forensic data analytics. And this is primarily in the CFO's agenda. It is obviously used during an investigation process, but how companies are proactively using forensic data analytics to identify and use them in their organizations. I will also talk about a few of the solutions that today we help clients with in effective deployment of forensic data analytics, and just probably close this with one or two case studies that we have worked on. We do this annual survey, and clearly there is benefits that has come out from forensic data analytics. When we have reached out to CFOs, they have talked about the biggest one was 88% of the respondents said that it helps in better risk assessment. So if you have insights of your data, if you know in terms of what are the patterns, what are your potential hotspots, you basically address in terms of doing a focused assessment on that particular area. It could be a location, it could be a vendor, it could be a customer, it could be a particular business. So how does analytics or forensic data analytics help in identifying and doing the right risk assessment? Obviously, today we talked about data, and the size of data keeps increasing. How does, again, a focus analytics helps in identifying risk and patterns from large volume of data? And this could be the structured data, which is, again, which is all of you are aware of, your ERP systems, and this could be the non-structured data, which is the other data which is available in companies. And these could be emails, this could be access, this could be customer master, it could be the vendor master. All of these are unstructured data that we are talking about. And today, all that is available in a digital format, which can be analyzed and identify and helps in identifying of patterns and risk. If you look at the areas where FDA is being used currently, it's used both on the proactive side, which is how do you protect your environment, how you protect your company, how do you protect yourself, and it is also used during investigation. And obviously the first one, traditionally forensic data analytics has been used in investigation. When things have gone wrong, when someone has defrauded your company, obviously the volume of data that you have that you need to analyze is so huge that you need to focus on something, right? You need to focus on a particular vendor, customer, and so on. So if you look at the top of the mind for a CFO still, that forensic data analytics has been very, very helpful on an investigation, internal investigation. 31% people said that very effective, and 50% said somewhat effective. But if you look at the ones which are slightly below, it could be in terms of due diligence. It could be in terms of due diligence. It could be in terms of identifying a financial fraud. So there are benefits not just from an investigation perspective, but also on a proactive basis, how companies are using forensic data analytics. Just again, one statistics here, but we do this every year, and we clearly see that the spend by companies, by CFOs, are actually increasing on forensic data analytics. In the last 2 years, the spend has increased almost by 51% in companies' budget on forensic data analytics. Now companies have a dedicated resource and team which does analytics for the CFOs. Obviously, the compliance team, the risk team, the internal audit teams, they use that. But today, CFOs are having people within their function who actually does forensic data analytics also. how does the various anti-fraud controls, and this is a ACFE. ACFE is the Association of Certified Fraud Examiners, and they did a survey globally around 2,500 odd companies and people, and these are the different type of anti-fraud controls that companies has, right? So you have the code of conduct, you have the proactive data monitoring, and so on. The most interesting part, if you look at here, is proactive forensic data analytics is actually the one which helps companies, which is the number 2 case, reduce the median loss on account of fraud, misconduct, leakages, 52%. So if you look at the median loss for companies which had a forensic data analytics in place was $80,000 US, vis-a-vis companies which did not have, which was 165. Again, and we see the first one obviously is the code of conduct. If companies don't have a code of conduct, there's a serious problem there, right? So if you don't have a code of conduct today, employees don't know in terms of what the way they need to behave, what is the policy, what is the process in the company. So that is a must that you need to have. But the second most thing that we are talking about is forensic data analytics. So again, it's important that you as CFOs understand it's just not a cost. How do you benefit from forensic data analytics? And I was just looking at the next one. If a lot of us rely on external audits, but if you look at that's way below. It's only obviously it is a control as well. But there, if you look at, it's only 29% of the loss that gets mitigated by having an effective external audit, for example. From a finance perspective, you would have seen similar dashboards earlier. So how do you analyze your accounts payable, for example, right? And these are all visuals that today, CFOs use when they analyze their data. So if you look at the visuals here, talks about, spend on vendors. So who are your vendors that you're dealing with? Which locations are they based? What are the type of vendors we are talking about? And these are, on the left-hand side, these are the vendors, these are the analysis through the structured data, which is from the ERP system. But you also have the unstructured data, right, which can be mined in from the companies, and then you actually have a risk aggregation that happens here. So based on this, you actually find out, if you look at the summary, you find out that you have one particular vendor that you are spending more, one particular vendor which is in a high-risk country, one particular vendor that you have just done one transaction and then that vendor has gone silent. You get to understand, for example, there are some vendors that the company deals with, the regular transactions is say $1 million every month, and in one particular month you had $10 million, and these are obviously comes as a visual tool to the CFOs. But just by having this sometimes doesn't help the CFOs too much, and that is where today we risk rate every criteria. So you might have 10 different criteria in terms of how do you identify potential problem vendors, but you need to risk rate them in terms of some of the risk rating for a particular vendor might be higher, some of the risk rating might be lower. So aggregation of the fraud risk with the risk rating helps the CFO in identifying the right transaction that needs to be investigated, because ultimately if you have exceptions, you need to investigate that, or if you at least need to review that. And that is what CFOs are doing in terms of aggregating, understanding the fraud risk rating them, and then identifying. And these could be at the end of it genuine, clean transactions, but you need to understand and you need to identify whether they are clean vendors, these are clean transactions without any suspicion. In a couple of clients that we have worked with, this is what today we have given to the CFOs, which is a continuous monitoring dashboard. And this could be, here there are examples both from the vendor side and the customer side, which is just not on transactions. So you overall risk rate a vendor, right? Now your vendor could be a sanctioned vendor. The vendor could be operating in a country where the geopolitical risk is high. So you need to have some weightage that you need to give to that vendor or your customer. The case may be either. So how do you identify who are your overall risky vendors? Because as a part of your due diligence process, as part of your know your customer process, you need to know every detail about these vendors and customers. So a dashboard like this is something what today is not necessarily just a transaction, but what is the quality of vendors, what is the quality of customers that you are talking about? And in case you cannot read, the various parameters that we have put in here is what is the quality risk, what is the country risk, and what is the transactional risk. All put together actually gives you an overall risk for a particular customer or a vendor. And once you have that, you need to have someone in your team to look into these transactions, these vendors on a deeper basis. So for example, if you look at some of the examples where in this particular client, we found out that 1,000-odd payments were made to bank accounts which was not in the vendor master. So you have the vendor master, you have the bank account of vendors, but through the exception process, there were payments which are made which were not to these accounts. So again, there could be business reasons, there could be approvals that has come in, but again, these helps you identify, is there a particular vendor who is always asking you to make payment to different bank accounts? If yes, what could be the reason? If you look at, some of the vendors had multiple bank accounts instead of one. You could have vendor in Singapore, but the vendor is asking payment to be made in Dubai, for example, right? So how do you spot these transactions? Because on a standalone basis, if the vendor sends you a mail or it sends a mail to to the finance team, you might not remember in terms of 6 months back, this vendor actually asked a payment to be made to Dubai. Now he's asking the payment to be made to Australia, for example, right? So how do you get all this information together through an analysis? This one, for example, right? The vendor has given a GST number, a VAT number. How many of these are active? So because you have a combination of alphabets and digits, how many of these are actually real numbers and are not fake numbers? How many of these don't even have a GST number? I wanted to share now, 2 case studies, and this one was the first one was in ASEAN. It's a large conglomerate which has their own loyalty card, and this was something that the CFO actually called us, and we were working with the CFO. So the company had a loyalty card. They had millions and millions of customers, and the loyalty card was basically used across multiple businesses of the client. They were into retail, they were into construction, they were into healthcare, and the same loyalty card was being used. And the CFO actually called us and said, and it was also being used as an e-wallet where you can transfer the points between two members, and the points has value. The client came to us and they said that because the risk of loyalty, because the number of customers that are using loyalty cards are increasing, and because it has a dollar value, every point has a dollar value, I want to protect in terms of leakages. I just want to be sure that what we are rolling out is good enough. It's never foolproof, but at least good controls are there on the loyalty program. So what we did, primarily 3 things. We first did a fraud risk assessment to understand what are the processes that companies are following, because the way you earn, for example, loyalty points in a particular type of business, say retail, would be different than how you earned a loyalty point, say if you're buying a house from the same group. So what are the processes? That was the first step, to understand what is the current process. Then as EY, we have what we called a fraud risk library for every sector. And then we found out, then we went and saw what are the different type of frauds which are possible in the loyalty schemes, right? And this is both technology, non-technology frauds. So you have an app today. The frauds that can happen through an app is very different than what it can be the normal card-based or the paper-based loyalty program. So we identified in terms of what are the processes, what are the fraud risks for that loyalty program, both from an insider perspective and outsider perspective. So an employee in your company could be committing a fraud. A customer can be committing a fraud, right? We are talking about point-to-point transfer. So can there be collusion? Can someone from the back end change the points, for example, in a loyalty scheme? So you have 10,000 points. Can the 10,000 points be made 1,000,000 points? Possible? Not possible? So those are the type of schemes. Those are the type of scenarios that we think through. And then the last one is how do you automate this process on a continuous monitoring perspective? So if you look at what we did, we basically segregated all the risk into 10 different buckets, right? So you have, for example, risk of manual override. You have risk of unclaimed rewards. So lot of time, everyone I'm sure in this room has multiple loyalty programs, and you have earned loyalty programs points on all those cards that you are probably holding. But a lot of these points are unclaimed because either it's not too large or it was one-off transaction and you don't bother. What happens to those unclaimed points? So there are obviously risk around that. You have manual override. Companies have always, in the finance process, always sometimes when you actually manual override, the system controls. So what are the fraud risk around that? So we basically made 10 different scenarios for the CFO and pulled the different fraud risk for each of these scenarios and gave him a model in terms of identifying on a regular basis what are the type of exceptions that are coming out in the system. So for example, if you have a manual override, is the manual override done by one particular person? Is it for a particular set of customers? Do the set of customers have something in common? Those sort of indications comes out through the manual override data model or the scenario. And this, all the 10 that we have, sprint 1 and sprint 2 is basically when we implemented it to the client, these first 5 models was implemented first, and then the second set of models were implemented. Today the client has these 10 models that runs, which on a regular basis spits out exceptional behavior, exceptional transactions. It could be internal, external, and then the internal audit team or the finance team goes and looks into it effectively to find out, is there a problem or these are general trends. So this was one of the things that we did. The second case was for an insurance company where, again, this we did it with the CFO and the internal audit team, where company wanted to identify unusual behaviors. And these are unusual behaviors of agents in an insurance company. Every insurance company has agents who actually sells your policy. They wanted to identify who are our rogue agents, because a lot of agents, they get huge commissions from the sale. So how do you again identify on a continuous basis who are your potentially rogue agents? So again, the scenario was this we did for 13 odd countries for this client in the APAC region, where we identified various parameters that could be that help us identifying the suspicious behavior of these agents. And again, the next few slides talks about how did we risk score them, how did we identify exceptions, patterns. So for example, if you look at this one, it just says that a particular agent has sold many policies, but most of his policies are getting lapsed next year. So primarily the first year agent fee is so high that he gets the agent fee and then it's not getting renewed. So it's the loss, like Manik said, sometimes lost to the company where you have paid upfront agency fee to these agents. And then you get outliers and so on. Again, very effective model which is currently used in this insurance company that I'm talking about across 13 countries.